All right, good morning, everybody. We finally got here after waiting all week. We're going to get CPI this morning and then FOMC this afternoon. Very likely, the move that we get from CPI will be washed back out, and then we'll just hold sideways into the afternoon. This does present with a gap close play, and it fits into the narrative that will hold sideways into 2 o'clock. So with that in mind, we do want to think about the gap close play. I tend to show this whenever we're going to have the opportunity for one of these. Just keep in mind, even if we get the setup, there's still no guarantee that price is going to actually go to the gap close. Now, I get it. You don't see a gap, you see a candle. So why do we call it a gap? It's a liquidity gap. The idea that, consider the dome and at price, everything above is ceilings, everything below is floors. If you wipe out a bunch of floors really fast, then the liquidity that shows up in there is really weak. It didn't exist until now. So what's the phrase? Last in, first out. It's a liquidity gap, not a price gap. And price can move back through those ticks that we had moved down, can move back through it very quick. This setup can be bullish or bearish, doesn't really matter. It's visually easy to see. You don't need any special tools. You don't want a wick at the start of the candle. In this example, we went down, so no wick or barely any wick, right? I mean, there's a little nubby up there, but it doesn't matter. And it closed really close to the other side. It didn't close in the middle, nowhere near the middle. It didn't pull back and leave a big wick down here. It closed near the end of the candle. We built a bit of a base, and we started working our way back to where the gap started, and we got there around 11 o'clock. Here's a different example going in the other direction. 8:30 print, almost no wick on the back side of that candle, closed near the top. We got back to the gap close around 10:30. It's not bad. 10:30, 11. This really didn't give much of a base, just a straight shot, and then it worked to get the gap close. Another example, 8:30 print. This one is CPI. It pulled back a little bit off the high, leaving that wick, and you can kind of see why we don't want that to happen. The next candle was stuck in that range, had to build up, then work through it. Then we based, finally got back to the gap close about 10:45, 11 o'clock. This is what we don't want to see. This was non-farm payrolls February 9th. You can see how there's a lot of wick. First, from the open, there was a lot of wick down there, but also up here, there's a lot of wick. And it closed close to that 50% value. We don't want that. If that's the kind of setup that we get, there's just no gap close play. Now, this did go back down and close the gap, but it's not about whether or not it actually performed the move. It's if we want to trade that move. If we don't get the setup, I'm not saying that you can't trade if there's no setup. Obviously, there's going to be something else we can play. But having the gap close setup is kind of it's a really easy play when we get the setup. So you kind of want to play it when you got it. Another example of what we don't want, big wicks on each side, price closing near where it opened. That was June CPI. Probably last year's June CPI. Another example, what we don't want, big wicks on each side. And another example, big wicks on each side is something we don't want. Now, these things can show up all over the place. Here's an example on the intraday where we got one at 10:30 or at 10 o'clock, excuse me. Then we had another one around 12:30, which was almost immediately closed. Then we got the gap closed, but we ended up creating another one, and that one was closed. So these can overlap each other. They can come in multiple times in a day. They're not just an 8:30 print. The gap close play. So this is what we're looking for. Up or down, doesn't matter. Just a nice, clean setup. Even if you don't trade this, understanding this will help you so that you don't try to short the hole or you don't try to buy after that really big move to the upside, especially say at 9:30 after we had a really big drive to the upside or to the downside, that you're not trying to take it farther in that direction. So even if you don't want the gap close play, if I can save you from, shorting the hole or buying the high, then at least we got that done. We're basically green and or flat around the world. Hong Kong down a minor amount. Everybody waiting on this data, big data print. We do got a European Central Bank speaker today too, so worth keeping your eye on that one. CPI at 8:30, this guy at 9, and then Powell at 2:30. The statement's going to come out at 2 and then Powell at 2:30. That's more than enough. And of course, it is Wednesday, so you have your crude oil inventories for those of you who like to play oil. This is the range that we had discussed on Monday, 400 to 300, with an overshoot into the cog line 52.92 or 54.11. And we got close. We made it up to 53.92 cog line. Kind of stalled out here. But that was the base case argument. We would hold the line into today, and so far so good. We've got a gap up this morning, but we're not really all that far from the pivot point. We weren't able to get above the R1 level, but we really want to reevaluate this at 9:30. If we've gapped up higher than that R1 level, then price could use that R1 as support. But it needs to be firmly above it, not just at the level or, slightly beyond it. Say like back here where it got to the R level and really it just dropped right back down. Same thing here. It's not what we want. We want a good, clean, definitive close. And although that didn't hold, that'd be the kind of behavior we would want. If we get above that R level before the open, it can act as a support when we get into the open. Otherwise, we would still expect to hit the floor pivot because that's what price does more than 80% of the time. It hits the floor pivot. We would have to have the same expectation as today as any other day. Now, because it's CPI and we're going to see some volatility, we could hit both sides of that, jump into the R1 and drop all the way down and hit that pivot. So then it wouldn't be a missed daily pivot anymore. Either way, doesn't matter. Got to get into the open. And the fact that we're up but not above that R level means that we could come and hit that pivot point. We turn on the channels, we can see the channels are overlapping, and it's a very wide channel, kind of implying that even with all of this volatility and the possibility of some big moves from CPI, that we could just mean revert by the end of it and pretty much be right back where we started, like a gap close. These wide channels imply that we won't break out and we won't expand, but I can show you many examples where we had a wide channel day and price broke out and expanded anyways. So, this is just a guide when it comes to the width of these channels and kind of give us a starting point on what to expect for the day. They're not set in stone, and these channels don't make price go sideways, or they don't make price expand when we get those really narrow channels. Price isn't moving because of these channels. These channels just give us idea about what price should do today or what price is likely to do today. Still waiting on Spot Gamma to come out with their AM notes, which I just checked and they did. Love it when they do it right in the middle of my stream. So we'll have to take a look at what they wrote, get a little bit of a feel for the call wall and any levels. Pretty sure that the info is going to be something like nothing's changed, still waiting on CPI, blah, blah, blah. I will get the Spot Gamma founders notes posted, and then you guys will be ready. But beyond that, 5,400 is still a significant level, even if the call wall has been moved. Thinkorswim's a little slow today. At least it's running again. Down detector yesterday showed it was down for a lot of people for a lot of the day. Some people said they had to uninstall and reinstall before it worked. I didn't have any issues with mine, but so the call wall hasn't moved, still 5408. The I think the put wall was above the zero gamma yesterday. So it could be a little dance between those two right now, but volatility trigger seems to be the same spot. The call wall still in the same spot. Really focusing on last week's candle. We've got the 111 as a warning. That would really line us up with 5,400 anyways. And if we can get through that, then 5418 is the next stopping point. We would expect to get there, consolidate base. And if the breakout is true and it's going to stick, then we would continue to move after basing at that level. But right now, the fact that we're outside of Friday's high or last week's high, we can use that as a line in the sand, place where price should not go back down below. Not necessarily a support per se, it's more of just a place that we need to stay above. So 53.85, now that we've taken it, we need to keep it. Because of CPI and the volatility that we get with CPI, it's very likely that we're going to breach that level and get back down underneath it. We do have a market maker move this morning, so they're hedging, they're worried, and they're spending money. We could see the volume's a little light, 54,000, but they are concerned. Otherwise, they wouldn't hedge. Hedging is cost. You know, with the average retail trader, we can come up with really ingenious ways to try to hedge a position. And, you know, I've seen a few traders use hedges just for the trade itself. They didn't really have anything that they were trying to protect. They were just using the hedge trade in the hopes of making some profit. When it comes to the institutions, those hedges are just pure cost. You might as well just, you know, light a match and burn money with it. They're not using it to make profit. And the only analogy that really fits is having house insurance for a fire. You don't burn your house down to make a profit, right? Because you'll never be whole again. Even if you get all of the insurance money, you wouldn't be whole. There's just some things that are irreplaceable. Hedging is not going to make you whole. It's just there to cover some of your loss, right? So when they're spending money on a hedge, we know that they're concerned. They wouldn't burn money otherwise. Now, we know why they're concerned at CPI day, but if you ever come in and you see that they're hedging and it's not a major economic day, then you got to just call timeout and go figure out, why are they hedging today? What do they know that I don't know, so that you can be in the know? Go figure it out, right? Go hunt, hit the news, ask questions of somebody, try to figure out what the econ is today and why are they hedging. No surprise, we know why today. No big deal. 10-day, 30-minute volume profile. Nothing here should change anytime soon. The point of control isn't going to move from this spot anytime soon. And we're not going to lose the bottom of this profile for days yet. So the only thing that can change this is if we were to break to the upside, say get into something like 54.50, then we would end up with more of a B-shape profile, and the point of control would still be down in this lower level because it wouldn't move up on that long stem at that point. That would really be the only thing that would change the shape of this profile. Otherwise, if we do break these lows and come back down, we could build out closer to this 5,300 or 5,290 cog line. Then we could start to develop that B on the lower side. In the profile world, we don't really have a B. We actually just have two Ds. And one of those Ds would have the profile in it. But that would require breaking through this shallow zone and getting back down into this lower level, this high volume node, and then staying there long enough to move the point of control. With the expansion that we got yesterday, we now have a VPOC below us. $53, $54. So any break to the downside today, that'll be one of the places where we look for a first touch bounce. Considering the move that we had yesterday, still got to be able to ask that question. Did we move too far, too fast yesterday? Does it owe us a pullback? Any sort of mean reversion, least squared methods, dot plot statistics, anything like that that says we're going to turn around and pull back because we went too far? Nope. We're not overbought. We didn't move too far, too fast. We're not due a pullback. And there's no reason to expect any sort of linear regression at this point. Today, while you're watching the market, looking for an opportunity after CPI, if you have Thinkorswim, you've got an advanced decline line. It's got money built into it. You go to Market Watch, visualize, choose the index that you want. That can be your own personal watch list, say the Mag 7, but you can go down to the ones that say public, and you can pick things like the NASDAQ 100. These are detachable screens, so you can have more than one. They fold up into just a tiny little window, so they don't really take up much real estate. And you want to keep your eye on the capital plus the issues. In this case, issues are companies. NASDAQ 100, there'll be 101 because Google's in there twice. So you want to watch the capital flow versus how many issues or how many companies are moving up versus moving down. Any sort of divergence in there kind of helps out. Say you have 40 advancing, 60 declining, and yet the money flow is 5-1 bullish. Follow the money, right? Go where the money is. Since these stack up really nice, you can do this for all the different indexes out there. So load one for the NASDAQ, load another for the S&P, maybe one for the Mag 7. They don't really take up much real estate. The only problem is if you were to leave them like I have them right here, tomorrow when you start your Thinkorswim, they'll be back to the heat map. And then you got to go in and set it back to the index. It doesn't seem like it's a really big deal. It just gets annoying all the time. Look for the opportunity to see things adjust because of CPI rather than waiting on the Fed. Everybody's pretty confident the Fed's not going to cut, and they're not going to announce a cut, right? They're going to continue to dangle the carrot of, well, we're not going to cut, but we will cut if we have to cut. If we need to cut, we will cut, but we won't cut because we don't need to cut. That kind of round and round, circle language. So everybody's pretty comfortable with the idea that the Fed's not going to do us anything, which sends everybody back to CPI. Now, we could see an adjustment in the dot plot, possibly, but the Fed's still not going to cut unless they have to cut. End of story. So CPI is probably the bigger play. Want to keep your eye on the advancing minus the declining issues today to see if everybody starts to agree with that and we break this range that we've been talking about all week. It might not wait for FOMC. Nat gas down 2%, which kind of makes sense because over the last 5 days, it's been up over 13.5%. Kind of do a little bit of a pullback at this point. And uranium is up with the FANGs and Bitcoin and expanded tech semiconductors. It's a decent space, to see the things that are up. That's kind of what we would want to see. But maybe some more of the older tech would be nice to see in there. Semiconductors, I mean, a lot of times if you see SMH up, that could just be NVIDIA itself, not necessarily, the broader semiconductors who probably want to pick and choose in there. And expanded tech can show up on Thinkorswim from the after hours yesterday, not from the pre-market this morning. And so that can be a little bit misleading. Whenever I see IGV in there, I always go in and check, is it from last night or from this morning? We can see from this morning, we got a little print. It's working its way back down from overnight higher move, but it is up. This isn't flow though. This is like just a little algo print. We want to see some real flows with a candle that actually made a move. So IGV being up, okay, I mean, it is, but I wouldn't give that any weight. MU's gapped up. Got a nice little lift here. Compared to some of the other chips that we were looking at this morning, this one certainly looks better than the others. And TSM, really nice gap up here. It had an inside day breakout. I don't know if it's going to be able to keep it for much longer. So MU and TSM seem to be the better two semis at the moment. Yeah, at least it's not NVIDIA again. I wouldn't get too comfortable with the things that are up at this point or the things that are down at this point. Everything's likely to change when we get the CPI, almost like an etch-a-sketch, right? Things are going to get shook in 32 minutes. So don't get comfortable. Crude, uranium, pot stocks, semiconductors, Bitcoin, and precious metals are trying. They're just not there. They're not up enough. It's a good start. For that rising tide, we want to see it spread right into everything that we can get. I expected a little weakness out of China, not actually heading to the downside, though. So KWeb down. EDD, JD trying to fight, still inside yesterday's range. Baba, big drop. It's really trying to unwind that. And Baidu. It could be what's going on with the G7. You know, they're trying to slap China's hand a little bit. It's really hard to say at this point. So watch the clock. Keep your eye on the CPI. Keep in mind that even if we get the setup for a gap close, it doesn't have to close the gap. There's always the possibility that it just keeps going. Otherwise, if we don't get the gap set up, then for me, there's no trade for the gap close. We'll find something else to trade. Be careful